Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to talk about velocity banking, aka paying off our debt like a boss. And I don't know if you knew this or not, but people who are making $150,000 are living paycheck to paycheck these days. And why would that be? Well, according to the AI, Google AI, we got lifestyle creep, we got inflation, high cost of living, student loans, home ownerships, right? So these two are related to debt. And I think lifestyle creep is related to debt too, because how do you creep your lifestyle? You just get more debt, right? And so what we're going to do is talk about paying off our debt. And let's assume we make $150,000. And if let me just do this 150K after taxes, and then we'll just use George as an example. So 8,600 a month and learn to pay off our debt. So let's go ahead and get to it, boss. All right. So what's velocity banking? All it is a debt payoff strategy where we dump all of our money into a line of credit, and let's assume that we make that 150K salary after taxes about 8,600, and we got all this debt. Three credit cards, we got a sweet auto, $50,000, so it's probably a really good auto or a ripoff like a truck, right? And in fact, it was probably a truck probably over 90,000 these days. And then a student loan, 75,000, a cheap mortgage, 200,000, right? We want those, we love those cheap mortgages because even if we overpay for other stuff, look at this. Bought a $300,000 property for about $200,000 at the peak of the market. That's what you want. That's where the money is, right? So let me go back here. Oh, let me reload this. My screen is going crazy. All right, so let me go back here. And so let's assume we have a $200,000 mortgage at 3%, but we have $2,700 in general expenses, food, gas, insurance, and all that. And, you know, I wonder how many bosses and business owners of the world know about this debt payoff strategy because I'm assuming, let's say you make $1 million a year, you probably got $1 million property and are probably almost paycheck to paycheck because of your debt, right? I mean, look at all those people who live in like San Francisco. And you know what's crazy? I was looking at Zillow listings, right? The recent solds. And there was one listing in San Francisco where someone put up a real estate or a property for $2.7 million, and then it was under contract, and then, like, 2 weeks later, when it was under contract, they paid 3 million. It was like, how's that even work? That's crazy, right? Like, usually as a real estate investor, you put things under contract so you can negotiate the price down. Well, in San Francisco, at least in the retail market, they put under contract and then it goes up somehow, right? I don't even know how that works. A crazy market out there. Alright, so now when we do this velocity banking stuff, this is what we do. We don't have any savings. Okay. We don't have any savings. So if we take a look here, right? Let me just kind of go here to my checking account. This is zero. I don't save money. Money comes in, right? Money goes out to the line of credit, but I don't put any money into my savings account or checking account, right? So, but we are going to have an idea called cash flow, which at the beginning looks very similar to savings, but once we start throwing all of our money into debt, then this number should increase. Okay. So this is what we're going to do. We're going to assume we have access to $100,000 line of credit. And this is the most unrealistic part, right? So here's the magic secret that you need to brainwash yourself with. And this is actually a good financial foundation for you when you deal with lending institutions and banks. Banks don't lend money to people who need it. Shocking, right? It's not like a restaurant. A lot of people think like if I go to the bank, it's because I need money. No, no, no. If you go to a bank when you need money, they see you as a huge red flag risk. They don't want you out of there. And this is how I have over $579,000 in lines of credit because I don't need money, and then therefore I get it. And then when I need the money, I already have it, right? See how that works? That's how a bank wants to see you. They don't, when you get a loan or a line of credit, they don't want you to see money. In fact, let me ask ChatGPT this. Yeah, let's ask ChatGPT. Does the average person understand the concept that banks don't lend money to people who need it? Not really. Not really. Nope, they don't really understand that, sorry, right? So, it's kind of a strange concept to most people. And that's how you win with money when you understand that one little concept. Okay. So let's go ahead and play this.
Not really. Most people assume that banks are in the business of helping individuals in need, but they often don't grasp the nuance. Banks prioritize lending to those who can demonstrate they don't need it. This boils down to risk management. Banks want to ensure their loans are repaid, so they favor people with strong credit scores, steady income, and a history of financial responsibility. It's counterintuitive but aligns with the old saying, you can only borrow money when you prove you don't need it. Financial literacy is often limited, and many don't realize this dynamic until they experience it firsthand, like being denied a loan despite needing it urgently. Have you encountered situations where this concept really hits home for people?
When I was in the beginning of my financial journey, I thought a bank was kind of like a restaurant. I go to a restaurant because I'm hungry and I need food. Therefore, the bank would be the same for me. I go to a bank because I need money. Ooh, it updated its memory so it knows how I think.
That's such a relatable analogy, and I bet it's how a lot of people think at first. It makes sense on the surface. Banks have money, and if you need money, they should just give it to you, right? It's only later that you realize banks aren't in the business of giving, they're in the business of making money by minimizing risk. It's a bit of a wake up call when you learn how much they prioritize your ability to repay over your actual need. How did that shift in perspective impact how you approached your financial strategy?
I only got the money when I did not need it. Alright, let's see that. I wonder if it makes a difference if I put it in all caps.
That's the ultimate irony, isn't it? It's such a hard lesson to learn, but once you get it, it completely changes how you think about building credit, saving, and leveraging financial tools. Did that realization push you towards strategies like velocity banking to work around the system?
Alright, so, how do you think I got these huge lines of credit, including this one, and I have 579,000 in total, and it's gonna keep growing. I might get to 1,000,000 in a couple of years, or maybe next year, I don't know. But, yes, banks don't lend money to people who need it, and once you need the money, that's when they don't wanna lend it to you. Be aware of that, okay? So, let's just go here, and I'm just gonna do this thing, and we have access to a $100,000 line of credit, so it's a line of credit. All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. So a credit card is technically a line of credit, but we have these other lines of credit tools like a home equity, personal, business, depending on your flavor. But the cool thing about those lines of credit is that you can use it to pay anything. Like I remember I got a $50 bill on my line of credit, and you know what I did? I borrowed the money from my line of credit and then put it back, $50 payment satisfied. Isn't that crazy? Like I didn't like I had no idea these tools exist before I learned velocity banking. So let's just assume we have access to $100,000 line of credit. And how much credit card debt do we have? 25, 28, 29. And how much is this? This is 82,000. All right. So this is what we're going to do. We're going to have an $82,000 balance in and we're going to do a debt transfer, right? And so once we transfer debts, guess what happens? These payments go away. We start out with the credit cards. It's like the cheat code. Short-term high interest rate loans and high interest rate credit cards, we get rid of those first. And then here's our last step, entire paycheck into the line of credit, take our expenses out, and then rinse and repeat over and over again. Look how easy that is. Oh my goodness. Pay off debt like a boss. And if you're an employee of a company, your boss probably doesn't even know this. That's the sad part. And that's why your boss is probably broke, right? So let's go ahead and do this. And that's why I think a lot of employers, to be honest, kind of cheap out with their employees because they themselves don't know how to manage their own money, even though they probably make a lot of it. And they're probably freaking out that they pay so much taxes to the tax man. So they look good on paper, but they don't know how to manage that either. So, really, the two biggest costs that come to you when you make more money is taxes and interest. So, you got to learn how to manage those. All right. So, let's go ahead and do this. And I'm going to do The interest part, so how do you calculate the interest? It's based on the interest rate, average daily balance divided by 12. Even if you don't understand the formula, just copy it, right? Like, here's the thing, a lot of people, they try to understand everything first and then uh do it, and then that's kind of what slows your growth. I just kind of do stuff and then later on I just understand it, right? So we're gonna go ahead and do this, paycheck in, expenses out. And then I'm gonna go ahead and do this here. So in 27 months, look at that, we paid off all that credit card debt. That was pretty easy, less than 3 years. So 27 months, this is 82K. All right. And then let's get rid of these loans and look at that. So let's go to our loan calculator, 27, 27, 27. And how do we prioritize our debt payoff? By using this thing called the cash flow index. Let's look it up. What does it mean? Cash flow index. It's just a formula where we divide the statement balance divided by our loan, and then uh, I think of it as a ranking system. So anything that's a low number indicates an inefficient loan, meaning that if we pay it off, right, we pay it off, then we get a lot of cash flow back, right? So that's what it means. So think of it like this: we have this huge number. If we pay off $190,000, we get $843 in a cash flow back. If we pay off 28 grand, we get even more cash flow back than paying the 190,000. Isn't that crazy? So same interest rate loans, right? So this formula ignores the interest rate and only focus on the cash flow. So what we're going to do is take this low cash flow index and move it into the line of credit and pay off our debt like a boss. So let's go ahead and do this right here and then do this plus 28424.22. And then what we're gonna do, okay, is we're gonna just do this 0 right here because we paid off the auto loan or moved it into a line of credit. And let's see how long it takes us to pay off this loan with our new cash flow, right? So now this is minus 4224.14. And I'm gonna do this, and we'll see that in 34 months, it's completely paid off. That was simple. All right. So it still hasn't even been 3 years yet, right? So 34 months equals 82 plus 50. So it's 132K. All right. And then now we just have two more loans left, the student loan and the mortgage. Once upon a time, I heard someone who made a lot of money, over $200,000 a year, said, "I still want to keep my student loans because if I make the payment, it looks good in my credit." That was the most insane thing I ever heard, but to each their own. And I never try to preach in from person to person. I always try to preach in a group. So whoever like wants to accept the message, um, I want them, you know what I mean? Like, I don't wanna, like, deal with one-on-ones because, if the person doesn't understand where you're coming from, then it's very hard for them to, like, take in the message, if you know what I mean. Alright, so now let's go ahead. So this is 0, so now this is 34, 34, right? So now, okay, 58,000 to get $832 back. Now, here's the thing. Um, if it's below 50, I'm okay moving this to a line of credit. If it's above 50, I'm like, eh. And then I also tend to look at the interest rate, especially if it's above 50. So if there's a huge interest rate difference, like 3% in loan versus 8% line of credit, I'm a little iffy on that, right? But for here, this one is 6%. There's a 2.2% difference, so it kinda makes a difference, and we could probably save money by doing what we call the chunking method, but for this demonstration, yeah, you know what? Let's just do the chunking method, right? Let's go ahead and do that. So, luckily, we have this velocity banking calculator to help us demonstrate the chunking method. And so, what's the chunking method? It's just basically how much you're moving into a line of credit so that you don't segregate your income and you just help pay it off, right? So, like this one in this example, it's like I'm moving $9,000 of the loan to the line of credit, and then just kind of doing that as an example. So, let me just go ahead and do this right here. Okay, so what's the original balance? The original balance is 75,000. Ooh, we went to maybe an expensive private school, didn't we? Or maybe we got a sweet job, over $150,000 without having to go any graduate school. That would be awesome. Don't have to go wait, a billion years to be a doctor, which is kind of probably why a lot of them have mental health issues. And, I don't know if you knew this or not. doctors and mental health, right? So a lot of them, a lot of them, um, I'll just say this, right? Just because you make a lot of money doesn't mean that you have good mental health. And I think for some reason there's this thing to sacrifice like sleep and mental health in order for you to make money, but you should never do that, right? Too many toxic things out there and toxic people, toxic money. What's the payment? 832.65. 832.65. And let's go ahead and put in that income and the expenses. So let's just go ahead right here. 8,600 is our income. And our expenses are everything except for the loan we're trying to pay off. So it's just these two right here. And then I'm going to sum it up. So that's going to be 3543.21. So 3543.21. And then we'll just chunk $9,000 into the line of credit and $47 of interest. Probably a little bit more than that. What's the current balance? It is 58084.85. 58084.85. Ooh, 1 year. Okay, so 1 year to pay off that student loan. Oh, excuse me, I'm burping. I don't know why I'm burping. So let's go ahead and do this. So it's 34 plus 12. So it's 46 months and the student loan's paid off. Look how easy that was. You see this? This is now 0. And then, so now it's 132 plus 75, which is 207K, right? 207K. And then now it's the mortgage. So at 46 months, we got to figure out what the balance of that mortgage is. So 46. And then we just do the chunking method, right? Now, I know what some of you are thinking. Oh my goodness, 3% mortgage. Oh, this is like the end of the world if you use an 8% line of credit, right? Now, there's a complete difference between using the chunking method versus, okay, replacing your loan with a line of credit. Two totally different things. And a lot of people don't realize this, right? So I'm just going to quickly show you. Yes, if there's an interest rate difference, you might end up paying a little bit more. Okay. The question is how much more and is it worth it? Right? Because what happens with a lot of people is that when they make extra direct payments to their loans, they start freaking out because A, your income is segregated, right? So let's say you start not dumping all of your income into the line of credit, income segregation happens, which is how banks make money. And then number two, okay, you freak out about not being able to use your money, even though you could use your line of credit as a backup. But again, that's where income segregation happens. And so we're trying to prevent this thing called income segregation. Okay. But let me just show you here what happens. And let me re-update this. I think this was 2,700 is now our expenses because it's everything except for the loan we're trying to pay off. Yeah, 2,700. So let me just show you this. So let's say we got a 0% 30-year mortgage. I know it's crazy, right? I don't know if that's possible unless you get an owner finance, which we could talk about later. So 200,000, 200,000. And then the payment amount is 555.56, 555.56. Now, what's the most that you can overpay? So if you have a 0% mortgage, that literally means there's no interest on the mortgage for 30 years, right? But people are freaking out. Oh my goodness, 8% line of credit. This is the end of the world. Well, if you use this chunking method, it's highly, and I'm not saying it's 100% foolproof. It's very resistant to the interest rate. Whereas if you do a line of credit replacement, like replacing your loan, look at this, 27 grand. So 1 grand versus 27 grand, right? And you spend more time. So again, but once two things. Number one, the debt payoff order is really important. I've gone over this in other videos, right? So if you don't pay it off in the right order, you're going to end up paying a lot more interest than you should. And then also number two is that, let's say you attack the mortgage first. I've done scenarios where it's like, oh, we're going to do a first lien HELOC replacement, replace all of our debt, credit cards, loans, mortgages, with a line of credit, and then people ended up paying $100,000 more than they had to, right? Don't want to do that, right? But let's just see how much what happens when we just kind of do our current scenario right now. So 843.21, 843.21. And then what's the interest rate? It is 3%, and the current balance is 183,290.93. So 183,290 point, is it 93? 92. 0.92. Okay. And did I screw it? There we go. 2.8 years. I don't know about you, but I've never heard of anybody pay off their mortgage in 2.8 years. Wait, did I do that? Is that 2 years and 9 months? Hold on. Let me just do a quick calculation. 2.8. What's 0.8? 0.8 times 12. Yeah. Actually, I did that, right? 2 years and 9 months. Oh my goodness. I actually calculated a scenario where someone paid off their mortgage in 2 years and 9 months like I did. It's a Festivus miracle. Oh my goodness. All right. So let's go ahead and now put this right here. So 46 times 46 divided by 12 plus 2.8, and it's 6.6 years, and we are debt free like a boss, right? Like not like a booze, like a boss. In fact, I wonder from a marketing perspective if I could create a company called Boss and then just spell it wrong. I feel like certain companies have done that. Like a boost, boss, boo, like yeah, like a boss. Just deliberately misspell it. I can't remember, but I feel like certain companies have done that. But let's see, is there a boss emoji? Boss emoji? Boss emoji. Yeah, look at that. Boss's emoji. Let me go ahead and copy and paste that. All right. Where's that copy and paste function? Is it even here? Uh I don't even know. Okay. All right, I'll just do smiley face with sunglasses for today. All right, so we'll do that, and that's how we became the boss by paying off our debt in 6.6 years, and then this is now 0, and then 5,900. Ooh, now we got rich people problems. Oh my goodness. What's rich people problems? When you got too much left over in your savings and you're a little bit nervous because you got, your savings rate interest is not beating inflation, right? So, all right, well, that's it for today, folks. This is Korean Atlanta Mentorship. Have a great day, and I'll see you on the next video.